Covered calls. They sound complicated, right? But don't worry, they're actually quite simple once you break them down, but trust me, they're not. In fact, they can be a great strategy for generating extra income from your stock holdings. Here's the deal. You own a stock and you think it's going to trade sideways. That means you don't expect the stock price to move up or down significantly in the near future. You sell someone the right to buy that stock from you at a specific price, the strike price, on a specific date, the expiration date. This is known as writing a covered call. Think of it like renting out your stock with a chance to sell it at a profit. If the stock price stays the same or goes down, you keep the premium and the stock. For this right, you get paid a premium. This premium is like a bonus payment for giving someone the option to buy your stock. That's right, cash up front just for holding your stock. It's a win-win situation if you play your cards right. Let's say you own 100 shares of XYZ stock trading at $50. This is a solid position, and you're looking to generate some additional income from your holdings. One effective strategy you can use is selling covered call options. You decide to sell one covered call option with a strike price of $55, which is slightly above the current market price. This option will expire in a month. By selling this call option, you collect a premium of $2 per share. Since you own 100 shares, this results in a total premium income of $200. This premium is yours to keep, no matter what happens next. Now, if XYZ stays below $55 by the time the option expires, the option will expire worthless. This means you keep the $200 without having to sell your shares. It's a win-win situation for you. Even better, once the option expires, you can sell another covered call and collect more premium. This strategy can be repeated, generating a steady stream of additional income from your stock holdings. But what if XYZ skyrockets to $60? This is a scenario every trader must consider. In this case, the option buyer will exercise their right to buy your shares at the agreed strike price of $55. This means you will have to sell your shares at $55, even though the market price is higher. However, you still make a profit. You sold your shares at $55, which is $5 above your original purchase price. Plus, you keep the $200 premium. So, while you might miss out on some potential gains, you still come out ahead. Covered calls are a great strategy for investors looking to generate additional income from their stock holdings. They work particularly well in a flat or slightly bullish market, where stock prices aren't expected to move significantly. If you think a stock is going to trade in a range, covered calls can generate extra income by allowing you to collect premiums. Remember 2022? The market was down, but many stocks were just stuck in a rut, moving sideways without much direction. That's a perfect environment for covered calls. You can take advantage of the lack of movement to earn extra income, collect premiums while the market churns, and enjoy the added benefit of having some downside protection. Here's how covered calls provide some downside protection. If the stock price falls, the premium you collected can help offset some of the losses. That premium you collect, it cushions the blow if the stock price falls, making covered calls a versatile tool in various market conditions. Covered calls can be used with individual stocks and ETFs. Love Apple stock? Sell covered calls? Bullish on the S&P 500 index? Covered calls on the SPY ETF are your friend. Remember, covered calls are a way to enhance returns and manage risk effectively. They're not a get-rich-quick scheme, but a tool for long-term investors. So, are you ready to boost your investment strategy? Contact DeshCap today.